Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 5th of December. I'm Daniel Lam, your host for the podcast. After some consolidation over the earnings season, the Magnificent Seven once again led the way, leading the breakout in US equities. Now, one of the key supporting factors is the retreat of the US 10-year government bond yield from the key resistance at the 4.5% level. This helps boost the valuation in growth stocks in general. So why the retreat in yields? Well, in our opinion, it had to do with Trump's pick of Scott Bessent to be his Treasury Secretary. If Trump's policies were seen as ideological and inflationary, Bessent's ideas would help soothe the fears out there. During the election campaign, Bessent referred to former Japanese Prime Minister Abe's three arrows reflationary policies in the context of the US. So first of all, he aims to lift US trend growth to 3% from around 2% through tax cuts, deregulation, reshoring of manufacturing jobs through strategic protectionism. However, he wants to do this by lowering energy costs and reducing inflationary expectations by boosting US oil and gas output by 3 million barrels of oil equivalent per day through deregulation and making more land available for drilling. And thirdly, cut the US budget deficit to 3% of GDP by the end of Trump's 4-year term, from over 6% this year, by lifting economic growth and cutting wasteful government spending. Bessent's proposed non-inflationary growth agenda helps explain why yield has been falling since his nomination. His policies is characterized by gradualism. For example, he has advised using tariff as strategic negotiating tools by imposing them in tranches, tying them with set objectives that US trade partners will have to meet, such as increasing imports from the US and investing in production facilities in the US. Now, we believe that Bessent's pro-growth policies are likely to sustain the US expansion, and therefore we stay bullish on US equities over a 6 to 12 months horizon. For bonds, we would like to use any rebound in US 10-year government bond yield towards the 4.5% level to lock in the income over the longer term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.